Hello, on the screen is LT Foods Limited Quarter 1 Fiscal Year 2026, the earnings conference call. This is the transcript of the earnings conference call, and a lot of important things were said in this conference call. So let's read. All right. So the first thing comes from page 3 of this transcript. Okay, no more saying conference call. All right. An important thing said by the management here is that due to increasing customer preference for healthier and sustainable food choices, our organic business reported a remarkable 32% growth in this quarter. All right. And the major portion of the growth has been contributed by soya meal. Otherwise, normalized growth other than soya meal is around 18%. So organic business growth was 32%. Major contributor of this growth has been by the soya meal segment. And other than soya meal, normalized growth has been around 18%. Page 4 of the Concall. All right. More statements by the management. Our organic arm, Nature Biofoods, launched a new facility in Rotterdam to support our global ambitions in July 2025. So, new facility was launched in Rotterdam. This strategically positioned facility in Europe Gateway Port. So this strategic facility was positioned in the Europe Gateway Port, handles 1,500 metric tons annually, positioning us to capture more of the EU $45 billion organic market. So this port is, okay, sorry, this facility is located strategically and it just positions them to capture even more of the massive $45 billion organic market of the European Union. Next point, again by the management. In India, the household reach of Dawat brands, has grown significantly from 45.56 lakh homes in March 2023 to 56.2 lakh homes in March 2025. So the brand Dawat is now reaching to more and more places and more households. It's increasing its dominance. All right. Moving on, now we have some questions by analysts and answers given by management. All right. The question is, so maybe firstly, can you comment on the SGA? SGA are the selling, general, and administrative costs. So can you comment on the SGA trend this quarter because it seems to be running higher than what is expected? And separately, could you also quantify the impact of the freight cost this quarter because this has been consistent, I suppose, in the last few quarters? The question is comment by management on the SGI and A trend, which is the selling, general, and administrative cost trend. And the second question is also on the impact. Can you quantify the impact of freight costs this quarter? All right. Now the answer is, so yes, you are right. SG&A expenditure in this quarter as a percentage to revenue has increased. As stated by Monica, the major increase in the revenue is on the brand investments which you're making. So this quarter itself, my SG&A expenditure as a percentage to revenue increased by almost 1.2 percentage points. 1.2 percentage this quarter itself. This is mainly on the brand investments. So the answer is the selling, general, and administrative costs rise this quarter was mainly risen driven by brand investments. So LT Foods is now investing more on its brand, its brand image, and all that. So that's why these costs rose. Okay. Now the question is, okay, maybe specifically, what percentage of revenue was spent on freight and what percentage of revenue was spent on marketing related costs this quarter? Okay. So the answer, I believe, does not really answer the question. He asks for the percentage of revenue, but nonetheless, the management's answer is, so my logistic cost as a percentage to revenue has reduced by 90 basis points, which is 0.9 percentage points. whereas my brand spend as a percentage to revenue has increased by 120 basis points as a percentage on year basis. All right. Logistics cost decrease as a percentage of revenue by 90 basis points. Branding spend as a percentage of revenue has increased by 120 basis points year on year, not quarter on quarter, year on year. All right, all right. Moving on, we move to page 7 of the con call. Oh, we're already on page 7 of the con call. Okay, all right, all right. So the question is, first thing is our expectation of North America, and our performance both has been interesting, like 33% growth in a market where we are already a leader. And the future expectation is also 10 to 12%. So can you share some thoughts where we are already a leader? How can we expect to grow at double digit numbers? Or was there any one off in this 32%? So LT Food's biggest market, North America, where the majority or the biggest portion of its revenue comes from, it grew by 33% this quarter, year on year. So, and they're already a market leader. They control, I believe, 54% market share in the North American, I believe, the basmati rice market or the basmati rice or the jasmine rice market, whichever rice it is. And the analyst is asking how can they achieve 33% growth. I believe that's it's basmati rice, but nonetheless, the answer is yes. So in USA, as Monica just mentioned, the 32% is contributed. The Golden Star acquisition has completed. So this 32% growth has been due to an acquisition. But, twist. If you normalize that, if you exclude that acquisition, then the core category has grown by 18% on Apple. So we expect that the consumption will keep growing in America. So other than that the Golden Star acquisition, growth has been 18%. Very, very nice. Moving on, we move to another page. Okay, okay. Now, here the analyst asks a question. Let me make myself smaller. Right. The question is, we have also mentioned that we are going to invest in brands. So as a sales, what are we targeting and what we used to incur in, say, prior years? All right. The answer is broadly, it can be quarter on quarter difference, depends on what kind of the plan is. But on average, 3 to 4% is the plan. So from what I understand, the management is saying that on average, the plan is to spend 3 to 4% of sales, 3 to 4% of sales, I believe, on brand spend, on brand investment. All right, all right, all right. Clear answer, clear answer. Now, or the thing that management said. This is important. This is margin guidance and return on capital employed guidance. The statement is we are more focused on growth and we are expecting, as guidance is given, 12 to 5% to 13% EBITDA margin. That's the guidance for EBITDA. Then EBITDA margin, guidance for EBITDA margin, continuing the statement, adding to it a return on capital employed. So we are quite confident as to return on capital employed part to deliver a robust return capital employed 21% plus. 21% plus is their plan on return on capital employed. All right, all right. Moving on, we move to next page of the quarter. Okay. The question by analyst. All right. First is if you can just give us some sense on the Horeca contribution is to us total US revenue and the same number for the Europe revenue. The idea is I'm trying to understand whether basmati in these countries is more consumed in home or in Horeca. All right, what is Horeca? Horeca refers to the RE refers to restaurants. I believe the HO refers to hotels, and the CA basically eating outside. We eat at home, we make food at home, and we eat outside at restaurants and all that. So Horeca refers to all that eating out. He's basically asking how much of the revenue that they make from Europe and the US by selling basmati rice, how much of that revenue comes from selling basmati rice for Horeca or eating outside purposes, and how much is it for home purposes? All right. The answer is yes. So for us, it's in the range of, it depends on origin to origin, but on an average, 20% roughly goes into the restaurant and food service, what we call is HORECA, and the rest is all home consumption. All right, 20% roughly goes to restaurant food services. And he adds on saying, on an average, as a global consolidated average, I'm saying 20 to 25% goes in for this Horeca, and the rest is home consumption. So 20-25% goes for eating outside and all, and the rest 80 to 75%, 75 to 80% of this rice consumption goes for home. Okay, okay. Now, question by analyst. This is for Europe. Why continental Europe has grown 57%? Is there some adjustments or one-off? Answer. Firstly, answering your question regarding the European. So, the European, as Monica stated, there has been full functioning of the UK facility. So, we have started a UK facility last year itself. So, that became fully operational. And that gave me an incremental revenue of almost 80 crores in this quarter itself. So they started a facility in UK, now it's fully functional, and that contributed to that massive 57% growth in the UK revenue. All right, we have a lot more pages to go through. We move to the next page, just the next page. I believe that's a very small statement here. Freight cost as a percentage to revenue is around 5.7%, and it's the same in last quarter as well. So freight cost as percentage of revenue was 5.7%. Moving on, the next page of this quarter. All right, very good question by analyst. Analyst asks, are we expecting double-digit growth in the US this year? Okay, okay. Now, what's the answer? The answer is that's what the plan we have given. We are expecting roughly double digit. We are expecting roughly double digit, which is in the range of 10%. So growth expectation in the US market is roughly 10%, and that is LT Food's biggest market. Now, finally, we move to few pages away from this page. All right, did I miss something? Yes. The question by the analyst is my first question is my first question is why this RTH and RTC? Now, RTH is ready to heat and RTH is ready to cook. So my first question is why this RTH RTC segment revenue has degrown, although the base is very small. So even though the RTH and the RTC, the base, the total revenue is so small, why has the revenue still declined? And at what level of annual sales this segment will break even at EBITDA? That's the question. The answer is yes. This year, what has happened in RTH, the ready to heat, and RTC, the ready to cook segment, one of the products had discontinued in this category. There was Dawood Sehat that we had launched 2 years back. So we discontinued this in the last quarter, the last year quarter. So it had a revenue share. So we had lost. All right. They discontinued a category. They stopped selling products of one category, and that led to this revenue loss. Okay. Continuing the statement, the management said, so otherwise everything is as per the plan and as per the target setup. And yes, very important, this segment will break even in the EBITDA category once it crosses the 350 crores mark, and which we expect it in 3 years' time. So this segment will be EBITDA neutral at 350 crores of annual sales, and they expect that in around 3 years. Okay, okay. Moving on, we move to the next page. Yes, the next page. All right. The analyst asks question. The other question I have is in terms of future growth plans that we have shared in the presentation, I see that you have mentioned that EBITDA will grow at a CAGR of 16%, whereas PAT, profit after tax, will grow at a CAGR of 21%. So can you help me understand what will change between EBITDA and PAT that will help us grow PAT faster than EBITDA? And this is asking, why is PAT growing faster than EBITDA? So the answer is, so this is normal. It is normal. Whatever the EBITDA grows, the PAT normally grows at a faster pace. If any constraint, any kind of industry, anyone. So yes, there are the interest and the depreciation components, which doesn't grow in the same proportion as the growth in the EBITDA percentage. All right. So however, EBITDA is growing, depreciation and interest costs, they increase at a smaller pace, and that's why PAT is growing faster. So our profit after tax, which we're expecting, is a growth than greater growth than what we're expecting in the EBITDA. But more to add to it, we are focusing more on the return on capital employed. Return on capital employed that we project to have a 23% plus in the going forward year. So from the 21 levels that we expect this to go to 23 plus. So previously they said 21% return capital employed, which they already achieved this year. They want to go 21% plus. And what they have stated right now, they've clearly stated 23% return on capital employed. They want to go 23% plus level. They want to go. All right, all right. We move to page 17 of this quarter. Oh, oh, that was the last page. Okay, okay, okay. That's all it. Yeah, that's all. That's all. So that was all. The massive growth in Europe market was due to the UK facility now working fully. Massive growth in the US market was because of this Golden Star acquisition. But even without that, it was 18%. Overall, return on capital employed margin clearly is around 23%. EBITDA margin was 12.5 to 13%. And they're spending more and more on, what was it? They're spending more and more on brand investments. That's it. Hope you liked the video. Have a nice day.